Joining us, two special guests, Professor Bibek Debroy and Jayesh Mehta of Bank of America Merrill Lynch. Thank you so much, gentlemen, for joining us. Professor Debroy, I want to kick it off with you. What's your sense? Too little, too late?
Yes, of course. But I think this is also partly about expectations. And an expectation had been sort of built up that a whole lot of announcements to stimulate the economy were going to happen today. If you build up those expectations, then obviously what has happened is too little, too late. One must also quite quickly flag the point that if one is looking for big measures, they are unlikely to emanate from the RBI. They are likely to happen outside RBI. And that is really the problem, and that's the reason investments are not taking place. It doesn't have that much to do with RBI.
So you're saying it's a case of poor expectation management. Jayesh Mehta, someone who tracks the rupee very closely, would you agree with that view of Professor Debroy and that it's poor expectation management that explains the movement of the rupee today, because it was showing a lot of strength in the morning and then fell sharply after the policy announcement? Is it a case of expectation mismatch? Were the expectations too high?
Absolutely. I think, as I said, like today morning, it's like, standalone, this would have come, without any expectation. People would have said, yeah, okay, some positive step, and but the actual money will take some time to come in, right? Whereas the way the expectations were built in today, right, which would, kind of envisaging that within a month we will see some large flow. And I still feel, it's the small enablers which is missing.
Professor Debroy, are you really expecting any of these measures, which do seem to give elbow room to foreign institutional investors? Yes, but maybe it's coming at a time when they're not quite interested to pump in their money here in India. Do you think in that sense it's not going to bring in the money that is intended to?
No, I don't think it will. And ditto actually for the ECB. By the way, unless I'm wrong, on the ECB the annual limit still holds. So all this liberalization is subject to that annual cap. Now, all of these looked at in terms of movements towards capital account liberalization. No one is opening up or developing the bond market. No one is going to object to them. But the main measures to reverse the negative sentiments will have to come from elsewhere within the government, including Finance Ministry, and the RBI can do very little on its own.
Right. Jayesh Mehta, do you agree with what Professor Debroy is saying? Measures may, of course, theoretically bring in $10 to $15 billion of cash flows, but not quite if one looks at the current economic scenario and the stance taken by various institutions.
Yeah, I think we can put this in two phases. Standalone this announcement, yes, it would definitely get maybe $10–15 billion over a period, but it will take some time. It will definitely take some time for that to come in, but it will definitely come through, right? It's not going to happen something immediate and overnight. But one of the big thing, why people feel a little bit disappointed, because there was a lot of expectation built out today morning, right? That there'll be some news which will come, which is going to make impact very immediately. Now, from that perspective, the enablers are not really there with the existing announcement. So that's what has put a little bit, on defensive. And if you look at the limits also, though more limits have been given, but on, say, maybe on the infra side, like if you look at 31st May, 1.8 billion was still unutilized on that 1 year one, right, out of the 5 billion. And then almost 16.3 was unutilized for the 3-year lock-in situation. So from that perspective, one has to see how quickly we can get this moving.
Professor Debroy, just comment on that point, a question that Sherry asked earlier as well. What's the point in hiking the limit if there are no enablers in the policy to bring in foreign capital? And to that extent, do you think a lot of these measures could end up as a damp squib, because even now the foreign investment limits are not being breached?
Yes, absolutely. And I do not think, well, look, the ECB part of it, what does it really do? It enables some companies to borrow more cheaply abroad. But is that the issue? There is plenty of cash floating around in the system. It is just the case that people aren't investing. And therefore the problem, as I said earlier, is with this melee of people not investing. And what I think everyone is looking for, I'm not saying any of these is going to happen, but what everyone is probably looking for is a signal like saying, we're going to do something about petroleum product prices, we will open up FDI in retail, we'll do something about pensions, we'll do something about insurance. Something like that would actually reverse the negative sentiments floating around.
Okay, we need to see stronger policy measures to reverse the negative sentiment. Jayesh Mehta, do you agree with that? Do you think foreign institutional investors want to see stronger policy reforms before they commit to the Indian market? And as a result, the rupee is likely to remain weak in the medium term?
No, absolutely. See, as again, you see, what we are been talking about, stronger measures, is from the macroeconomic point of view. And that's, of course, if that are implemented, some of the reforms are implemented, and that will also give buoyancy to the equity market, and therefore the equity flow starts coming in. So that's one part of it. All I'm trying to say is addressing it from a debt perspective. If you look at it purely addressing from a debt perspective, you can make debt attractive too, right? So debt attractive, it is as of right now attractive. The Indian debt is attractive, but you have a big showstopper. Maybe I'm sorry to repeat again and again, but I think I'm trying to make a point that unlike equity, the debt business is a net interest margin game. When any investor or somebody is investing, he is looking at either his cost of funds or his risk-free return and the spread over that. And normally, if you look at after hedging and all that, the spread would be maybe 2.25%. And if you think that 2% has been taken off in withholding tax, there's nothing really left for the FII.
But the question, Jayesh, is that what should the markets be prepared for in the short term, really? We're looking at a rupee. The outlook particularly is still expected to remain weak, unless you're going to tell me that you think it's going to get back, claw back and strengthen.
It will require more. But, rather than going into this, I would look at more broadly, If we look at till now, we are, largely importer. We have trade deficits, right? Until now, that was being, matched up by the FII equity flows. Now, to whatever is happening globally and locally, the FII flows are a little bit, equity flows are a little bit down, and we need to replenish that and replicate that with the debt equity flows, which we can really do it. We are almost there. Now we have larger limits. We have, if you look at February 2011, we were almost like only $20-25 billion total limits. We are now at $65 billion limit. And that's a big limit to start with, right? And the enabler, somehow we are not trying to recognize that debt is very different from equity.
Professor Debroy, looking at the current economic scenario and a goodbye to Pranab Mukherjee, where do you see some of these measures happening over the next few weeks? Do you expect that today was meant to be one big blockbuster, at least that's what the government thought, and it was meant to sort of mark a period of what will be consolidation over the next 3 weeks, because we don't know what's going to happen next given the political changes at North Block?
Well, I have absolutely no idea what the government thinks. I suspect it does not think at all. Take, for example, the quote that we heard from Montek Singh Ahluwalia a little while earlier, which said that all kinds of things are going to happen for infrastructure projects, which sort of builds up my expectations that something or the other is going to happen. Now, one of the stumbling blocks is the forest and environment clearances. Sooner or later, the government will come up with something which will do nothing to ensure that the forest and environmental clearances happen within a stipulated period of time, and once the clearances are granted, they will not be opened up with retrospective effect. Now, if you don't do something like this, obviously you've got an implementational problem, and the government, for what it is worth, thinks that it is introducing reforms, but actually nothing very much happens. Similarly, we've got all this noise floating around now that, something is going to happen to FDI in retail. And because it's not going to happen, you will continue to have those negative sentiments.
Professor Debroy, let you have the last word. I know it's not a good day to be criticizing Pranab Mukherjee, but on hindsight, you think he spoiled it all by giving it away on Saturday and by saying that, we'll come out with some massive announcements on Monday. The markets rallied, the rupee strengthened, and then what we saw was a bit of a damp squib. Markets erased all the gains, and the rupee subsequently weakened.
Yes, I do think that it was a statement that it was completely unnecessary to make. I do think he has not been particularly successful as a finance minister, but certainly he need not have departed with this bad taste in the mouth. For the others, I mean.
Right, thank you very much. We do appreciate your time, Professor Debroy, and of course, Jayesh Mehta. Appreciate your time this evening with a perspective on what was supposed to be a blockbuster story for the economy, but turned out to be a damn squib.